welcome back to the policy dialogue. And we're going to have the third session. Here, we're going to continue the discussion and talk about what policy can change in the decision making context. So, as per the previous session, we're going to have an international keynote speaker, and also we were going to have Hazel to give our presentation about more insights about financial decision making. After that, we're going to have complete the chain of design by testing by inviting two representatives from the industry to give comments reflecting on what we find in research. So firstly, let's welcome Professor Suzanne Xu from Cornell University. She is the Dean of Faculty and Research for the Cornell University C.S.C. Johnson College of Business and the John S. Dyson Professor in Marketing at Cornell Dyson School of Applied Economics and Management. Her main area of research is the consumer financial decision making, especially regarding retirement income decision. Ding Xu received a PhD from the University of Chicago and holds degrees in electrical engineering from the Cornell University. She is currently an MBER research associate and has been a visiting scholar for several years at the Consumer Financial Protection Bureau. Thank you.
I just wanted to thank CEPAR and CAMA and ANU for having me here. This was a tremendous honor. It's my first trip to Australia, so I'm very excited to be here. So I'm going to talk about behavioral science and decumulation, and just to get us grounded with context, I'm going to introduce a few terms first. So first of all, I'm trained as a behavioral scientist / behavioral economist. I work sort of in this space between psychology and economics, fits in well with some of the sessions we've already heard, and certainly with the research brief that was released today by CEPAR. So I'll be referring back to that as we go along. I'm also going to really bring in a bit of a US spin on a lot of the stuff we'll be talking about today. Most of my research has to do with the social security system in the United States and the annuity market in the United States. And so trying to sort of bring in the perspectives from that research into the environment here, but also really looking forward to what I'm going to get to learn from the rest of the talks today in terms of how the Australian system works. And the other thing I want to mention is just what do I mean by decumulation? It's not a word that gets thrown around always, and to me, it's really any spend down of a saved resource. Some of my earliest decumulation papers were actually what to do with really good bottles of wine that you've been holding on for too long. But it applies, of course, to retirement savings as well, and trying to help retirees when they get to that point of retirement and they've presumably built up a decent nest egg, how to figure out how to spend that down. So this question of decumulation, oh, I need a click. There we go. This question of decumulation is one that, this is my advisor, Richard Thaler, 20 years ago when I was working on my PhD, told me was something that was really important to start thinking about. Of all of his students, I think I'm the only one who's really dedicated my career to this space. He's on record for having said, we've made good progress on accumulation and retirement savings. He said that having done things like introduce defaults and auto-enrollment and auto-escalation into the US system for retirement savings. But the decumulation problem hasn't really received as much attention, and it's an even harder one for individuals to solve. I'll bring up another Nobel Prize winner who I've talked about this problem with. He's on record saying, this is Bill Sharp, that it's the nastiest, hardest problem in finance. Figuring out how to take these saved resources, retirement savings, and spend them down in a way that you don't run out of money, and it deals with all of the uncertainties and all the other problems that come with this environment, and sort of trying to get it right. And so that's part of what we've been trying to think about, is how to help people walk through this environment a little more clearly. All right, so I'm going to talk about 3 mistakes that we see a lot in the research about decumulation. And this is coming from having done a lot of research in the space, some of which I'll mention today, having worked with a lot of the industry folks in the United States on the space, and also having worked a lot with government, the Social Security Administration, and other government entities that are trying to figure out how to put policy into place to help with decumulation. And again, this comes back to sort of the theme for this session, which is how can policy help? What can policy do to help with some of these issues for decision making in older ages? So some of the mistakes that I'll walk through. The first one is about predicting longevity. The second one, just the general topic of decision-making about during retirement. And the third one is trust and fairness, which is a topic we haven't really heard a lot about yet today. And I'm hoping we can get some conversation started on that element. Okay, so let me start with the longevity one. The longevity question, not surprising, is, of course, central to the decumulation problem. If I have to figure out how to make my retirement income last for as long as I live, then I need some idea of how long I think I'm going to live. And of course, that's a major input that most people do not know the answer to, right? We're just sort of all taking guesses. The interesting thing about longevity, though, in terms of the decision-making around it, is that we need to distinguish between longevity and sort of life expectations. And those two things are slightly different from each other. Let me start with that first one, though, years in retirement versus years in work. A lot of times when I go talk to industry or other groups about the decumulation problem, it's a sort of sobering reminder that a lot of workers will spend 20, 30 years in a job, and these days, with life expectations being what they are, another 20 or 30 years after a job. So the years in retirement these days are getting to be about as long as the years working. When you think about it that way, that all of the income that you've saved up during the working years needs to be able to fund the retirement side, it gets to be a pretty scary problem. This cartoon kind of makes fun of it, but is one that a lot of us love. If we take a late retirement and an early death, we'll just squeak by, right? Trying to get it right for that span of time is really, really hard. The other thing that complicates this is helping people predict what that span of time is. And this is where the longevity versus life expectations comes in. So this is US data. This comes from the Social Security Administration. They've built this wonderful tool called the Longevity Visualizer that you can load it on your desktop and play with it. It's a lot of fun. It uses US population data to predict life expectations and longevity predictions for any gender, any age in the US population. And so, for example, I've gone in and put a male, age 65. What do his life expectations look like? Well, his average life expectation is 84.1 years old, right? That's a nice firm number. So that 65-year-old might look at that and say, okay, 20 years, that's how long I have to plan for. The problem that's a little deceiving about that particular number is that it loses the shape of the distribution that sits around it, right? That's that sort of 50% mark where the life expectation sits. You can see that on the graph where the solid line is. But if you look at the probability distribution, right, there's still a lot of years after that individual could be alive. And so just to take a particular point off of there, probability of living to age 95 for this individual would be about 13%. Right? That's an additional 10 years, and it's not a non-trivial probability. Getting people to think beyond just that mean life expectation and think about how long they might really be around. There's a fair amount of uncertainty around that, but there's some chance they could make it to 95 or 100, and realizing that there's all those extra years that need to be supported. The other thing about life expectations, we talked in here a lot already about biases and psychology, framing of decision-making. We did some research a few years ago where we looked at how the way that you ask the life expectations question can actually change the answers that people give you. And so the basic setup was that one group of people, we asked them a series of questions like, what's the chance you will live to age 75, 85, 95? Another group of people, we asked basically the complementary set of questions. What's the chance you will die by 75, 85, 95? When we ask the questions in those two different ways, we get very different answers. And it's a sort of very solid result. We see it over and over again. When we ask the live to questions, people start thinking about all the reasons why they could live to a very ripe old age, right? They start thinking about how healthy they've been and what their family members are like who've lived a long time and so forth. Versus if we ask the die by question, they elicit a whole bunch of other types of thoughts, like the fact that they haven't been to the gym in the last few weeks or family members who didn't live as long. it really affects the life expectation of those individuals based on how that question was asked. Now you could ask, well, how accurate are they? There's some other patterns in there, and the research brief today talked about over and under predictions at different ages. We see that in our data as well. So the answer in terms of which one's more accurate tends to depend on which ages you're trying to hone in on. But it's a real framing effect that's changing people's perception of how much time they need to plan for. Okay, so that's the life expectations problem, which is really central to this decumulation issue. There's all these other sorts of issues, and this is where the research brief and what Rafa presented today was so incredibly helpful, right? Large stakes decisions, multiple sources of uncertainty, in a lot of situations, an inability to learn from feedback. For example, a lot of the work I do is on the Social Security system in the US. Once you've decided to claim Social Security, it's almost impossible to back out of that. And so it's a decision you get to make once and you have to live with forever. Annuities in the US tend to be like that as well. Once you've decided to annuitize, it's nearly impossible to back out of it. So there's not really a chance to learn from feedback. And the emotional trade-offs in a lot of this as well. It was coming up in some of the last sessions, things like whether or not to get a reverse mortgage and how you feel about staying in your home during your retirement years come into these decisions too. So lots of different things going on, and we've heard today about how all of these biases in decision-making are influencing some of these choices. I agree strongly with that. I agree strongly with a lot of what Ben said in the last session about adaptive decision makers and building a choice architecture environment to help them make good decisions and think about the trade-offs. There's another piece, though, that we haven't really talked about today, which is thinking about how susceptibility to biases as sort of psychological measures at the individual can influence some of these decisions. So for example, in a lot of our work, we measure things like loss aversion. Just in very simple gambles, how loss averse do you tend to be? Intertemporal choice has come up in here in intertemporal patients. Another big one that we have found in these types of decisions, psychological ownership, how much you feel like the benefits are something that you've earned or you're entitled to. Those all influence the choices that people make as part of their decumulation journey. And so that's led us to, in some of our most recent research, thinking about how to customize the interventions. And again, I want to think of this as choice architecture, not just as nudges, but how do we create a systemic approach to helping people think about these decisions that takes into account their own individual circumstances, differences in their uncertainty, differences in their life expectations, differences in their household situation, but also differences in some of the psychology as well. And so we start to think about having a need to create interventions or create nudges, if you want to call them that are more customized and more personalized. The other thing I'll mention about this space is that Sophie and I were having this conversation earlier today. Retirement savings, everyone's goals are pretty aligned. We want people to save more. We want them to have as much resources as they can when they get to retirement. On the decumulation side, it's a lot more personalized. Everybody's situation is different. So we can't just put a single intervention into place that's going to work for everyone. So we started trying to think about how to build these customized interventions. Experimentally, this turns out to be a really hard thing to do because if you want to test a bunch of different interventions crossed with a bunch of different individual differences that we're also measuring, you've got a huge number of interactions to look at. Some of the results can just be spurious statistical anomalies. So we really have to plan very carefully how to test these things, theoretically driven in terms of the interventions that we're looking for, and replicate over and over and over again. Again, back to the design by testing as a major component of that. This is a project that we did on the Social Security claiming front. Social Security in the US allows individuals to choose any time between age 62 and 70 to claim. If you claim early, like at age 62, you give up a lot of financial benefit relative to claiming later. Most of the literature believes that the majority of Americans are claiming too early, and so one question is how do we help them think about the trade-offs so that they realize the benefits and costs of doing that. We've tried this whole set of interventions that come from the behavioral science literature on a large population to see what it would do. Some work, some don't, in terms of being significantly different from the control condition. We cross this with all those individual differences. That piece we've had less luck to really find those interactions of which people should get which intervention, but that's kind of the goal in terms of what we're working towards. The last mistake I'll mention, again, is one that didn't get talked about a lot yet today, but one that I think is a very important one, which is trust and fairness in these systems. We ask a lot of our retirees in terms of trusting the financial systems that we put together, especially in a space where, again, they're going to have 20 or 30 years that they're dependent on the payout and the ability to draw down those resources. In some work that we did on annuities a few years ago using a revealed preference experiment, so a choice-based conjoint analysis where people were choosing between annuities, and we could basically evaluate behind the scenes which attributes they were valuing versus not valuing, and compare that to the actuarial value of those same attributes. We find that some attributes are undervalued, some are overvalued, so that was one paper. But another really interesting thing that we found that we also published as a second paper was looking at questions about whether people see these annuities as fair. And with the US market, annuities up till now have been entirely a retail decision by consumers, by participants. It's not something that would come in through their retirement savings plans. We don't have a system like your super system. It was something that someone had to go and buy on their own from the retail marketplace. And they've been incredibly unpopular. Most people don't like them. And so that was part of what we were trying to understand. We realized in our conjoint experiment about 20% of people didn't want any annuity, no matter how good of an economic value it appeared to be. They just had a strong rule against annuities. And when we dived into that a little deeper, the biggest predictor turned out to be that they thought the product was unfair. And it wasn't even about the financial attributes of the particular product they were looking at. They just thought the whole class of products were unfair. They just really strongly disliked annuities. Someone who told them at some point in time, or somehow they believed, that this idea of converting your assets into lifetime income was a really bad idea to do and something that they weren't interested in. So we've been really trying to dive into this question of trust and fairness, concerns about the firm that I'm getting my annuity from, how much do I trust them, and this is part of why I'm really excited to hear the talks today about the supers and the communication that's happening with participants to try to help them, understand and appreciate some of those risks, but also concerns about the personal risks. What if I don't have money for medical emergencies, some of the stuff that Hazel's been doing? How do we help people think about the trade-offs that they're getting into by looking at these products? So in the last few minutes, and hopefully I'm not too far over time, I want to mention some of what's happening in US policy about annuities because it's really an exciting space for us and something that I think we have a tremendous amount to learn from the Australian system. You guys are much farther ahead of us in terms of building annuity products. If you follow US policy on retirement at all, back in 2019, they passed something called the Secure Act, based on sort of this perspective that, the retirement crisis is real. We have all these baby boomers, same sort of thing that you're seeing here of an entire cohort of individuals entering into retirement who have no idea how they're going to pay for that retirement for all the years that they had ahead of them. They made a bunch of changes to our retirement savings systems in the US, but one of the biggest things that they did that has really sort of turned the industry upside down and generated a lot of excitement is to build annuities into our retirement system. So traditionally, we've had defined contribution plans like 401ks, where workers are putting money aside every month into their defined contribution plan account. That money builds and builds and builds, so that by the point of retirement, if they've done well, they have hundreds of thousands of dollars, and maybe even more than $1 million saved up in that retirement plan. But we've, until now, given them no way to pull that money back out other than just take it as a big lump sum and figure out what to do with it on their own. And that's part of the problem we've run into. So with the Secure Act, retirement plans are now able to build annuities in and offer them to the employees that participate in these plans. Again, it's a bit of a change. The industry is really excited about this, but not quite sure how to implement it yet. There's a lot of discussion about how much should be defaulted, how much people should have choice, whether they can back out at any time after they've already chosen the annuity, right? What the trade-offs are. And that's where I think we have a lot to learn from your systems here. So a lot of industry people are starting to think about how to change the retirement plans. One of the first organizations to roll out something like annuities as part of their plan was the University of California. I was working for them at the time, so I helped consult with them on the communications to their employees about how to do this. They even stuck me in the brochure, which was kind of embarrassing. And being able to describe it as a paycheck for life, as something that you get out of the annuity, was a big piece of that communication. But notice that this is a big shift for the American market, where in the past, the participant had to go out into the retail marketplace and deal with it on their own, a very complex environment where they didn't really trust anybody. And now it's going to be the employer who helps walk them through this as part of a plan that they've already been participating in maybe for decades. And so the trust and the fairness and the idea that they're working with an organization that they already have a relationship with has been a really, I think, important piece of what might make this successful. Again, slightly different from this system you have here for supers, but sort of moving in that direction. Okay, so my 3 takeaways from this talk. From the life expectations, just a reminder that how you frame the question can change preferences. This is back to the idea that individuals are these adaptive decision makers and really respond to the choice environment across all types of things that we ask them to do in this space. Thinking about the fact that retirement income solutions have to be personalized. It's not just about getting them to save more, but getting them to think about all the uncertainties and all those other biases that we've been talking about already today. And the trusted partners, for us in the US, that's going to be the employer. For you, it's it's the supers and the relationships that individuals create with government and with other entities. But the fact that they really need to depend on the trust and the fairness built into that system to be willing to participate in it. So that's all I have. Thank you very much.
Thank you, Suzanne, for your wonderful talk. Next, we will have Hazel Bateman. Hazel is a professor in the School of Risk and Actuarial Study at UNSW Sydney and the co-deputy director at the CEPAR. Her research focuses on consumer financial decision-making, especially as it relates to retirement accumulation and decumulation, with an emphasis on interventions to facilitate better financial decisions. Her current research investigates the role of choice and information architecture on life cycle financial decision, including superannuation and housing. She also works on design of and the demand for retirement products, including annuity, aged care insurance, and home equity-related products. Hazel, in her research and out of research, Hazel also worked closely with government policymakers as well as industries, and also international organizations. So I will leave the rest of the time with Hazel.
And before I start, I'd actually like to thank Raf and Sophie and their colleagues for putting together such a terrific research brief. So it's just a terrific document that summarises a lot of the research that we've done in CEPAR over the last decade, probably, in this area. What I want to do today is to cherry pick some of those studies that appear in the research brief and just put into context how these apply to different policy interventions that the government can make, particularly in superannuation and retirement income decision making. And also, before I start, I'd like to acknowledge all my co-authors. Some of them are in the room: Susan Thorpe, Ben Yule, Fodor and Shang Wu, and there's probably another 10 or 15, possibly some online and around the place, who've also contributed. And this has been really real joint work. So I'm just a spokesman here, and all our work has been very joint and collaborative. Hope I can do it all justice. Okay, so I'm just going to sort of summarise what are the key things policy can do to help people with superannuation and retirement decisions. I'm going to cherry pick some of the academic research that we've done that illustrates what policy can do and I guess what policy can't do and mistakes that might have been made in some of the policies. And also a very quick set of dot points on what's next. And I think one of the things that comes through here is in all sorts of financial decision making, people don't do the right things because they just don't know things. And so they don't know the relevant policies, they don't know product design, they don't know the features of products, so people just don't know things. And secondly, certainly in the past, a lot of policy was introduced but not really tested. And so it seemed as though policymakers, industry and possibly academics would sit round the table and come up with things that they think people should know about and ways that this information should be presented without actually testing how people use that information. And this has come up in previous talks today too. So what can policy do? Well, in a very broad sense, we can design the choice architecture. And this is something that Raf presented earlier on today. So in the superannuation retirement income area, you can have mandates, you can compel people to do things like compel people to save in the superannuation guarantee. You can set defaults such as the MySuper default, which sets investment asset allocation. You can have sort of implied endorsement, which is I see how the minimum drawdowns in account-based pensions work. So people see that the requirement is to take a minimum drawdown by age, and that's what many people do. You can have tax incentives, such as incentives for people to make voluntary contributions, and you can also have free choice. And as Raf showed this morning, in the accumulation phase, we have a lot of this choice architecture. In the decumulation phase, it's largely free choice, but there is implied endorsement in terms of the regulated minimum drawdowns for account-based pensions, and most people do tend to follow those. You can also regulate information provision. So you can design financial product disclosure statements and fact sheets and hope that the general public interacts with those and understands the information. You can also have other sorts of information provision that's regulated, but it's not necessarily compulsory. And what I'm thinking of here are things like superannuation forecasts. So ASIC has regulations around how to put together retirement estimates and calculators, or the assumptions underlying these. Governments can also provide financial education. They can regulate financial advice. I think in the Australian context, it's quite interesting in the decumulation phase, they've almost outsourced this to financial market participants. So there's regulations now for superannuation funds to design retirement income strategies where it's their responsibility to help their members make decisions. So the government has really outsourced that. Rather than have general regulations, it becomes something at a fund level. And I think very importantly, the government can simplify its existing policies to help people interact with them. So what I'm going to do next is just give you a few examples of some of the studies that we've worked on over the last 10 years or so that illustrate some of these different policy interventions. And I'm going to start with defaults. So probably about 10 years ago, a group that included Suzanne and Fedor, we put together some experimental surveys. So this online experimental surveys looking at benefit choice. We had a product A, which was a lifetime annuity, and a lifetime annuity gives you insurance against investment risk, longevity risk, if it's inflation indexed, inflation risk. First is an account-based pension, which gives you a lot of flexibility but doesn't insure you against those risks. And what we wanted to do was to understand really if people understood that these characteristics of these two products. Did they understand that a lifetime annuity gave them insurance against longevity and inflation risk? And did they understand that an account-based pension didn't necessarily give you that cover? So we asked people to choose between these two products, which we called product A and product B. We worked out that we shouldn't give them their commercial names with people that didn't understand them. And as people went through the experiment, we increased the risk of ruin. So the risk that they would run out of money if they chose the account-based pension. And what our hypothesis was that if people understood these products, they would move to the annuity product, the greater the risk of ruin. Now, what happened in reality? Okay, in reality, people stuck to defaults. And the way we set this up, we didn't really start off designing a study around defaults. But we ran the study once and we had the default at a 50-50. And we saw that people, not everyone, but some people were sticking to the 50-50. Were they doing that because they stuck to the default, or were they doing that because they were using a 1-on-N heuristic? And so we moved the defaults to a 75-25 annuity account-based pension or a 25-75. And what I've got here is the whole distribution of people's final decisions. And we see that, at the 25%, 50%, 75% percentile on this graph, people were sticking to the defaults. Now, when people went through this experiment, we explained the products to them, and then we tested them on their product knowledge. And what we found was people who stuck to the defaults were people who knew least about the products. So the people who did well in the product knowledge test, who understand the products, they were more likely to take free choice, but people who understand the products least were the defaulters. So those are the dark columns. You can also see that people used other decision heuristics here. So there was a group of people who chose a 1 on n. So whatever we gave them, wherever they started, they went to the middle. And there were people who went to either end. So this is really just showing the strength of defaults, but also this group of people defaulting here were the less skilled people. Now, we've done other work on defaults over the years. So Isabella Debrescu, also part of our team, has been responsible for building a structural model which allowed us to work out the welfare costs of people defaulting. And obviously, defaults have high welfare costs if you're not in the right default. But we also find there's a group of people who default, who don't pay any attention, who actually trust their superannuation fund. So this here is a study that we did with UniSuper data. And we had information on the extent to which people defaulted at the different places you could in UniSuper. But we could ask them whether they trusted UniSuper or not. And we found a group of people who were trustingly disengaged. So they were quite happy to default, but they had high trust in their fund. So that's some studies on defaults. The next set of studies I want to introduce are a set of studies that look at financial product disclosure. Now, until recent times, this was one of the main policy tools that the government used to help people make decisions, or supposedly to help people make decisions. And our team, again, Susan, Ben, myself, and some others, we've looked at these different types of financial product disclosure over the years to look at how people use that information. So the first one I've got here, this is the investment page from a short form product disclosure statement. For those outside of superannuation, this is a disclosure statement of information about your superannuation account. Many of you have probably never looked at this. And if you look at the explanatory memorandum that came out when this legislation was introduced, the idea was with this particular page that it was to help people understand risk and return in their investment account so that they could choose an appropriate investment option. So we did lab experiments here, and we asked people to choose various, their most preferred investment options, and we could work out which information people were using when they were making these decisions. And we found that what people were using was not the risk and return information, but they were using this pie chart in the middle of the page. And so this is a case where people are probably not using the information as intended by the regulators. They're focusing on the pie chart in the middle of the page, and they're choosing as their most preferred the investment option that's got the pie chart with the most and most equal segments. And so they're sort of undertaking naive diversification in making their decision. And in fact, when they made that choice, they were actually using risk and return in the wrong direction. So this is a case of financial product disclosure. Policymakers are trying to help people, but they're actually coming up with information that is leading people to make inappropriate decisions, if people actually use that information anyway. The second one that we've looked at is the MySuper dashboard. And again, the idea here was that every MySuper account should have a dashboard. It should be placed in a prominent place on a super fund, or it should be in a central place, and people will be able to compare those dashboards and choose a MySuper account. So again, we tested how people used that information when they were making decisions. Again, we found that, or people found it very difficult to make those decisions. I'm looking at Dani here. I've actually cut and pasted this off the UniSuper website. So, yeah. So we found that there's a lot of information there. There's information about rates of return in a given year. There's rates of return over time. There's information about fees and costs. There's information about investment risk. We found that people had difficulty using that information. So they responded quickly to changes in fees, but had trouble responding to changes in rates of return. And finally, I'm not sure if many people are aware of this final retirement income product fact sheet. This came out in a discussion paper from the Treasury in 2018. And this was when we were talking about a sort of soft default called a CEPAR. And Treasury came out with a fact sheet that would help us understand the features of these different products and help us choose these products. So with my colleague from UNSW, Inka Eberhardt, we consumer tested how people used this fact sheet. Now what we found was people found this very complicated. It had information about your annual income. It had a risk measure, which was based on downside risk, so the extent to which the product insured against downside risk. There was a picture which showed how this product, how your payments would change over time, and there was something very complicated about return of capital and death benefits. And again, people found this completely complicated. They focused on the risk measure, and they didn't understand the access to capital. So when we tested people's understanding of products, they thought that an annuity gave them more access to capital than an account-based pension using these fact sheets. So I guess our bottom line here is this financial product disclosure just hasn't been working. And in fact, ASIC, along with the Dutch financial regulator, put out a report a few years ago, Disclosure Why It Shouldn't Be the Default. What's far more interesting are other sorts of information, regulated information that funds can use to help their members with decisions. So again, as part of the team, many in the room today, we have a linkage grant with CBUS. And as part of that linkage grant, we've been able to work with CBUS and use their member data. CBUS have actually introduced retirement estimates. 2012, 2013, they introduced retirement income estimates. We've been able to analyse that data, and we've also run separate experiments as well, following up things that come up from this research. Now, for those who aren't aware, ASIC regulates the characteristics of retirement income estimates, and funds are required to provide an estimate of income and also an estimate of future balance. And what we've got here is the page in 2013 that CBUS sent out to a subset of its members with this retirement income estimate information. Now, interestingly, or importantly, what a retirement income estimate does is help people with the difficult calculation of working out, if I've got $25,000 today, which is on here, what does that actually mean when I retire? So this page here is telling the member, your current account balance is $25,000, and it's done the complex compounding interest calculation and telling them that your estimated account balance is $198,000. But it's also helped them work out what that means in terms of their income. And so here it tells them that their income would be $11,200, and assuming that they get half an age pension, if they're married and they get half an age pension, it's giving them an estimate of what their future income would be. And so that's giving them much better information to help them make longer term decisions as to whether or not they're saving enough. Just looking at 1 year's data, so people who got this retirement income estimate, comparing that treatment group with the control group, we can see that there's significant improvements in both voluntary contributions and also interactions with the fund. So everything here in purple is the treatment group versus the control group in grey. And at the far end, we can see how voluntary, for those who received the retirement income estimates relative to those who didn't, voluntary contributions increased, more people were making voluntary contributions. Interactions with the fund were increasing and people were making more interactions with the fund. So that's calling the fund, emailing the fund, etc. Interestingly, non-concessional contributions actually fell. which is probably a good thing because people were making more tax-effective contributions. Now, we've done more work on this, and I think Susan's going to be talking about some extensions of this in the discussion later in the day. So this is something that does seem to work. Another thing that does seem to work is just-in-time product knowledge. So when we first started working on looking at people's benefit choices about a decade ago, one of the first things we did was a pilot survey, and we wanted to find out what people knew, what people understood, what people's retirement plans were. And probably not surprisingly, we found out that people really weren't aware of these products that us, who talk about these all the time, think everyone understands. So a third of our representative sample of pre-retirees had never heard of a life annuity. Many of them didn't know the risk management characteristics of that product. They didn't know that it lasted for life. They didn't know that it didn't vary with the stock market. They didn't know that it provided a guaranteed income level. Even less than 50% of our sample had heard of an account-based pension. Now, 10 years along the track, I'd like to think that people's knowledge had improved. We probably need to redo this survey and see how people would answer these questions today. But I guess the thing is, we can't assume that people know what the products are or what the characteristics of the products are, which is why just-in-time product knowledge is important. So if I go back to the experiment I introduced at the beginning. So in this experiment, as I said, we didn't call the products an annuity and account-based pension. We called them product A and product B, and we taught people about the characteristics of these products. Then we tested people on that knowledge, so we got a quiz score, and then we got them to do the task. And as I said, what we wanted to find out initially was whether people were sensitive to risk, whether they actually understood the implications of the increase of the risk of ruin as we increased it from 1 on 10 to 3 on 4. And what we found was, the most important variables here in determining people's risk sensitivities, people's sensitivity to risk, was their quiz score. So actually, if they actually understood the products that we introduced to them at the time of the decision, and also their numeracy skills. And this was more important than their general financial literacy skills. So again, this is showing the importance of these complex unknown products, actually teaching people to them at the time they're making the decision, rather than just assuming that everybody knows what they are. I did another study with some actuaries, and here we were looking at whether or not people could value annuities. And so again, we ran an experiment, and we elicited people's willingness to pay and willingness to accept a life annuity. And I guess our premise here was, if people understood what these products were, we'd have very close values for willingness to pay and willingness to accept. And what we found overall was that there was a huge range of people's valuation of annuities. But again, those people who scored, again, we taught people the products beforehand and we tested them. Those people who understood the products at the time they made their decision had a much narrower gap between willingness to pay and willingness to accept. And also those people who took time in the experiment. Now, in this experiment, we actually gave people a calculator to help them work out the difference between having a product that provided longevity insurance and one that didn't. Unfortunately, we gave everybody the calculator. So we can't work out from this experiment whether the calculator is useful or not, but we can run other treatments without the calculator to see how useful an online calculator helps people with their decision making. One final paper I'm going to talk about before I stop. I've started to do some work with Shang Wu and UniSuper. What we were interested in here was how people reacted to market volatility and whether the standard sort of communications that we give people, such as letters saying, reassuring letters saying, don't worry, the share market goes up and down all the time, just stay where you are, or the things that we're now introducing, such as benefit projections and goal trackers, how they affect people's decision making in these volatile markets. So we had people go through 4 years, hypothetical years of volatile market, a good year, 2 bad years and a good year. We put them in information treatments where we gave them the standard letter, we gave them benefit projections and we gave them goal tracker. And then we hyper-engaged people. And our hypothesis here is, in the future, we expect people to be more engaged. We expect to give them more information, more tools. How are they going to behave if we hyper-engage them? And so we gave them market headlines. So we actually, like the headline in the Fin Review, the share market's crashed 40%. We gave them that in the experiment. We gave them the option to click on a page that gave them the annual returns for all the different options of that fund. We then gave them the particular information treatment I mentioned. We gave them the annual statement so they knew how much they had at the beginning of the year, what the investment returns were, what their contributions were, how much they had at the end. And then we prompted them to think about whether or not they wanted to change their asset allocation and contributions. I'm just showing one table here. The difference between the first year and the last year. Now, the data is really interesting because people did a lot of things in between and we're still unpacking what's going on. About 50% of the sample didn't do anything, but overall, people ended up worse off. So we had a large minority actually over the 4-year period became more defensive and a small minority became more risky. And when sort of just doing some simple econometrics, the things that were driving people to switch were the ability to view people who clicked on the page that allowed them to look at the performance of the options, but also the information treatments that we gave them. So if people saw benefit projections or goal trackers, they were actually more likely to make changes when the market became more volatile. So that's just sort of a case of beware. You know, if you're going to super engage people, make sure you give them the tools to be able to sort of understand the information that they're looking at. I'm going way over time, so I'm going to just wrap up. So our choice architecture can help simplify decisions, but must be carefully designed. Financial product disclosure hasn't been helpful. Retirement income projections look promising, and the way that they're actually helping people deal with the complex calculation of working out whether what I've got today is enough for me in the future. Just-in-time information seems to help, because I think we just can't assume that people understand things. And we've also got to be aware that people are not aware of many of the government policies that they perhaps don't need to save for. So people aren't aware of the implications of Medicare and of having private health insurance and of some of the government support for aged care. And to some extent, people are probably saving and not deciding to spend because they're just not aware of the policy environment. What else have we got to do? There's heaps of work to do here. So we've tended to just look at superannulation decisions or housing decisions or aged care decisions separately, and we've got to look at all these together. This work, we haven't even looked at cognitive impairment and what happens when people are cognitively impaired and have to make these decisions. We know as people age, they're not making decisions on their own. Families are making decisions. Advisors are making decisions. Surrogates are making decisions. We haven't even touched that. And we're just starting to look at the effectiveness of digital tools. And something that many other people have said today, we've got to test these public policy interventions before implementation, because many of them haven't been tested and we don't really know if they're going to work or not. Thank you.
Thank you, Hazel. Following that, we will have 2 commentators from the industry. First, let's welcome Dani Murrie. Dani Murrie is the Chief Marketing and Growth Officer at UniSuper. She is also responsible for telling the story of one of Australia's largest superannuation funds and achieving ongoing growth as a fund open to Australians. Dani joined UniSuper in Jan this year, following an extensive career in finance, working across colonial First States, Westpac, Commonwealth Bank, and First Abu Dhabi in the UAE. Most recently, she led the operationalization of an enterprise-wide digital transformation program at MetLife Australia.
Okay. Hi, everybody. Thanks so much for all the fabulous information that you've both shared, Suzanne and Hazel. Incredible stuff. So, look, my reflections, I've got 10 minutes, and let's get straight into it. So, super policy can be and sometimes has to be detailed and prescriptive with clear rules in law. Super tax rules, for example, are fairly clear-cut, as we all know. Members need to clearly understand what counts as a concessional contribution and what are the consequences, say, of exceeding the cap. At other times, super policy can be more principles-based, spelling out key concepts or requirements, but allowing super funds more leeway to respond to and implement their own response based on the needs of their members. Now, an example here clearly is the Retirement Income Covenant legislation. We've long supported a retirement income framework rather than one that focuses on specific product features. That puts super trustees who are closer to their members than policymakers to use the local knowledge to put into place their own micro policies in response. So if we go to the next slide. For those of you not close to this issue, the Retirement Income Covenant is best thought of, say, as a legal obligation. It requires super funds to have a strategy to assist their members in retirement. We think that the retirement challenge requires a lot of flexibility and ongoing support for members, and the policies super funds put into place are likely to focus on the ongoing needs for assistance and advice. Ultimately, a good retirement requires retirees to know how to maximise income from their savings while meeting unexpected expenses, all the while managing their longevity risks. And as Suzanne, you said, that's no easy feat. In the face of this challenge, many retirees lack the confidence to draw a sustainable and flexible amount out of their super fund. Instead, they only draw the minimum, these small amounts, out of their super and end up with such a large amount of their retirement savings not being used and reducing ultimately the quality of their retirement. So the covenant is a policy aimed at getting more super funds to think long and hard about how to help members in their retirement. So what's UniSuper doing about this? And so if we go to the next slide, I'll outline what's been our response to the Retirement Income Covenant. And first and foremost, for us, this is not a compliance ticking exercise. For us, this is a central part of our strategy as a fund. Now that we're open and we want to compete, we want to be known as a leader in retirement. So we focused on supporting our members, thinking through how our members will make decisions about their individual retirement options. For those who would like more support but are not seeking personal financial advice, provision of information, education and guidance will form the main type of the assistance that we plan to give those members. We will also engage members at appropriate times to raise awareness of the support available and accessible to them at all life stages. So this really taps into what Hazel's talking about, those bite-sized relevant pieces in the moments that matter. Of course, we will continue to provide a meaningful range of products, but we also see a great need to focus on the services, education, guidance and advice. So, on purpose, UniSuper, we've changed our narrative internally 90 degrees away from product strategy to a service strategy, and one that is walking in the members' shoes around knitting together both a digital best-in-class response as well as a personal advice response, and knitting those together across the life cycle. So if you think about it, you've been exposed to human-centred design, that's what we're embarking upon in executing excellently this strategy. It also includes the development of a guided choice framework. The information presented under the guided choice framework will serve to inform, educate and guide members so that they are supported in the process of identifying suitable solutions for themselves. So if we just pop to the next slide, you can walk in my team's shoes a little bit as we were mapping out our retirement income strategy. And it started with the customer journey. So from cradle to grave, we've mapped out the 3 key phases of everyone's journey in life. And then there's 7 sub-phases, of which 2 of these sub-phases are our priority customer segments as we lean in and execute our retirement strategy. And they are the late savers, so those 45 to 55-year-olds. So it was great to hear earlier today that financial literacy peaks at 54. I was kind of in my head going, good, tick, I'm pleased we're starting with the late savers. But also our other priority customer group is those who are actively thinking about planning for retirement, so those 55 to 65-year-olds. If we go to the next slide, here's our proposition that I spoke about. So it's all about offering a best-in-class digital and person in-class, best-in-class experience. So when I say this, the best-in-class digital member experience is designed to engage and guide customers in their retirement planning journey in those moments that matter through an app powered by the customer's data. And in those moments that matter on life triggers, we would then educate them to engage them around setting goals for their future retirement and what they want to achieve, and helping them stay on track to achieve those goals through their life. Secondly, the full spectrum of assistance to help customers choose a retirement solution. We have it in two buckets, if you like. You've got members who are not seeking paid personal advice. They will have access to best-in-class factual retirement information, general advice, this guided choice framework that I spoke about. And then we have the members seeking the paid personal advice. And we have select, comprehensive and review advice covering that. Okay, next slide. So I thought I'd just touch on, well, because this is all about making decisions and the age making decisions, well, what decisions are our members making? And this is shown by these, this type of narrative I've got here. And it's the members who are converting their savings to retirement income. So for those members of ours who are eligible for defined benefit pension, what's going on? We see these members, they're electing to convert higher amounts of their savings to lifetime income streams. And this is at least half of their UniSuper balance is taken in the form of a defined benefit pension. And when I say more than half, it's in the 60% and up. So members who have not had exposure to the concept of lifetime income, so that's our accumulation type members, will they continue to start account-based pensions rather than the lifetime income streams? And it's these members in my mind's eye when I talk about who are the focus of our retirement income strategy and helping them solve that, really damn hard problem that we're all faced with, our lifetime savings and making them last through your life. And it's this is where our focus is about developing that best-in-class engagement and support through the use of the digital tools and calculators, provision of retirement information, drawdown guidance, and meaningful illustration of retirement outcomes. Now, if I just make a few comments about advice, because from our point of view, retirement, it's underpinned always by advice. So UniSuper's advice team helps at all stages of the financial journey by providing advice and assistance on how best to manage and grow the members' superannuation, their wealth. And in the past year alone, you might be interested to know that our team has supported more than 74,000 advice interactions with our members. Super funds have a central role to play in giving advice and assistance to their own members. Nobody is better placed to give this advice on their own fund but the fund themselves. This is especially important when it comes to defined benefit funds. We want to avoid a situation where there is a gap in the market where nobody is able to advise on this defined benefit fund, like a UniSuper one. We acknowledge, however, that not everyone will need comprehensive financial advice. Some members have simpler needs, while others wish to be empowered to make their own decisions and are looking for assistance, decision support tools, such as calculators and educational material. And we expect many super funds to develop tools to assist those members where the simpler needs or those who wish to be empowered to make their own decisions. Digital tools such as decision support tools will be increasingly important, and these decision support tools aim to help members make decisions themselves. What is increasingly clear is that members have differing advice needs at different life stages, and this requires a comprehensive advice offering. Access to high quality and affordable advice and assistance, therefore, remains a key part of how super funds will support their members through retirement. I'll just make one comment on the quality of advice review. So what we see is the major challenge with advice is the access and affordability to both intra-fund and comprehensive advice. And from what we have seen so far, the quality of advice review seems to be on the right track. Super funds are well placed to offer both traditional personal advice as well as phone advice and increasingly digital advice or digital support tools. One thing to note, currently we charge for intra-fund advice. Not all the industry do, but we find charging an appropriate fee ensures that those who receive the service will put a value on the advice that they receive, and they're more likely to act on it. So once again, it comes back to the decision making that this forum today is about. Our members act on our advice with 78% of intra-fund advice and 95% of comprehensive advice being implemented. Comprehensive face-to-face advice is typically implemented with the support of a financial planner, but we also support those who receive the intra-fund advice. Those members get a self-implementation guide. And we still find higher implementation rates than many of our peers across the industry. In fact, we see a clear link between the value members place on advice and the implementation of that advice. So we're really interested in today's dialogue because there's a lot super funds are doing and have to do to support their members in making better decisions as they age. So thanks for having me.
So we have a comment from Loretta. She said, framing experience, account-based pension versus annuity, suggests you need to include government age pension where applicable as a proxy to ensure transparency. Also, second point, UniSuper DB pension are very different to annuity, with DB pension much more favorable. Third comment, those who need advice, so for instance, age pensioners are less likely to be able to afford it. Any panel member want to address that?
I'll answer the first question. So yes, we did have treatment in that experiment where we had people with and without the age pension. So, and I can't remember your other two because I was thinking about my answer to that one.
I think the UniSuper second part wasn't really a question, it was an observation, so yes. Yeah, it's a comment. And the third, absolutely, that's the difficulty with the outcomes, the unintended consequences of the Royal Commission and the impact on the advice industry. Advisors are leaving. Advice is becoming very, expensive and not accessible to the average Australian. And that's because of the higher compliance requirements on the financial planning practices. So, yeah, if you're on an age pension, it's almost like impossible to seek comprehensive financial advice. You'd be generally just left to seeking general advice available online, assuming that those age pensioners can access the internet.
My question is to the panel, it's also to John, reflecting on the conversation we had before lunch, which is, why don't people in retirement have present bias?
Well, I can answer that.
Does it switch off when you're retired? Because the conversation's all about we don't save enough because we're present biased, and then we get to retirement and then we don't spend enough.
And the critical difference is we no longer have the flexibility of labour earnings.
So that outweighs that atavistic urge.
Uninsurable risks through retirement are extraordinarily demanding on capital, precautionary capital.
Let me add to that. So I think the precautionary motives are a big piece, but my dissertation was actually on the topic of future bias, and I can find it in other situations as well. The distinction to me between present bias and future bias is that when resources are hard to replace, right, if you only sort of get one shot at them. So again, I wrote a paper years ago on like a really good bottle of wine that you're only going to buy once in your life. It's future bias. You hold it and you hold it and you hold it and you wait for the right opportunity to use it. We find that in other consumer situations as well. So future bias exists as a human, tendency on our list of biases, but it's a little bit different from, chocolate chip cookies at lunch, where I'm very present biased. I'll always take the chocolate chip cookie and assume that I'll work it off later. Future bias tends to hit when I only get one shot and I'm going to wait for it in the future. And I think retirement savings is this, it's sort of this sense that if I spend it down now, it's not going to be there when I need it sometime in the future when something comes up.
I just want to add, I wouldn't think it disappears in the context of annuitization puzzle. The present bias is there. I'd rather get my capital, hold it, rather than amortizing it to my lifetime income.
And that actually reminds me, Social Security in the US, we find present bias. People want it at 62. They're not willing to wait until 65 or 70. And you could say, well, why is Social Security, which is essentially a lifetime income annuity, why is that one present biased? But we see future bias in these other environments. My co-author John Payne and I are working on a paper right now that argues that it's an endowment effect. It's a willingness to accept, willingness to pay difference, that if I already feel like the Social Security is entitled to me, I have a very strong feeling of ownership towards it. I want that money as fast as possible, and I'll give up something to get it started immediately. Versus, so it's I think your annuitization example, versus if it's I need to buy an annuity, which is the way the US market works now with the cash that I've accumulated, then that's a purchase. I'm not already endowed with that lifetime income. Now it's a very different psychological process to actually make the purchase instead of to just take something that I'm already entitled to. So yeah, that's a nice point. Yeah.
That future bias could be entirely logical if you think about sequencing risk in retirement. That's a comment, which is the future bias is probably very logical when you think about sequencing in return.
Yeah, and the precautionary, yeah.
I think I saw a question for Susan. Do you have Yeah.
Suzanne, you mentioned the beautiful brochure from University of California with your own lovely photographing, and the fact that it was employer or plan sponsor provided annuity. And we've all, including you, talked a lot about personalisation. So I'm just wondering if you could elaborate a little bit on how the university is working through that tension between personalisation and annuity provision.
I think it's a wonderful question. The University of California is this very unique plan sponsor in the US right now that is really the only one that has rolled this out. I still feel incredibly fortunate that I got to be a part of that, but partly as a result of that, I've been going to a lot of industry conferences within the financial services industry with other plan sponsors to have conversations about how to roll this out. And the question of personalization is something they take very, very seriously. Now, again, the US system, it's all through the employer, and so the plan sponsors, which are the employers themselves, are really working to figure out how to provide the kind of financial advice that's coming through the supers here as part of a benefit that they give to their employees, not just in retirement, but before retirement as well. So I think a lot of that personalization will come through there, through the consultants and the advisors who are working within the plans. But there's going to be massive differences in what plans offer, I expect. And they're all sort of struggling with this question of how to design these offerings. I mean, the product, or the comment that you made, Dani, about products versus services, that's something I hear from them all the time. They don't want to be in the product business. They want to be in the service and systems business of helping their employees through these problems. So it's a massive discussion that's going on in the US right now. Every month I'm pulled into another conference where it's being thought about. And I don't think they have answers yet, which is why I think there's so much to learn from what all of you are doing.
We got a question from Ralph.
Yeah, thank you. I just had a question about the financial advice stuff that you guys are both talking about, and also technology that you were both talking about, and personalization that keeps coming up. So to what extent is current legislation inhibiting those sorts of technologies happening? I understand from the review that that's one of the things that they're considering. Do you guys have a view about to what extent it is limiting and what needs to happen in that space?
Do you want to go first?
I'll go first. I forgot to actually mention that we are a strong supporter for the quality of the device proposal. We think that will actually make more funds to better engage with the members and utilize the data we have and provide help and personal advice to members. In terms of current legislation, the focus on compliance and risk has been the focus of industry and also driven the process of providing those tools and financial advice to members. We have to put in huge efforts to overcome those barriers to make it happen. So that's why we really welcome the the quality of advice review.
And that's the same for UniSuper. Our perspective is that what is in our mind's eye, executing out fully, would be limited without the proposed changes that are being telegraphed by the quality of advice review, with the way in which it seems to be that it will be tabled by the 16th of December. We're big proponents of that because it will enable funds to behave with much more certainty as it relates to helping people digitally, so that you can perhaps solve the first question around access to advice more affordably. We believe it can happen with the proposed changes around the good advice.
Let's have the last question, because we're running out of time.
Sorry, I'm just going to add a comment to the panel, which is I think technology often is brought to solving part of the issue rather than the whole issue. I think the challenge for super funds is if you're giving an answer to a specific problem, the member could rightfully assume you know an awful lot about them, you know their salary, their occupation, their address, date of birth. You start to get into quite a murky personalised advice versus general advice conversation. And so at the moment, I think technology is being brought to what I would call is the fairly perfunctory part of accumulating, which is some kind of risk calculator attached to an optimizer, which gives you a portfolio allocation. The scope is much bigger, but it's fraught with crossing the line between general advice and personal advice.
Thank you very much for all the questions and the panel answer, all the discussions. Let's have a quick afternoon tea, and we will be coming back in about 15-20 minutes time.